SpaceX just priced. You'll see that headline 10,000 times this week. Here's the headline you won't see. SpaceX isn't the wave. SpaceX is the trigger. CoreWeave already proved what happens when an AI infrastructure name finally prints. Now over 200 AI companies are lined up behind SpaceX, and most of them you've never heard of. That is the trade, and almost nobody is positioned for it. For 3 years, the smart money waited. The window was shut. The headlines said IPOs were dead. Then SpaceX said, let's go, and the biggest names on Earth are racing to follow. Here's what most people miss. The biggest money in IPOs isn't made on day one. It's made by investors who built a watch list before the crowd ever heard the name. So the real question isn't whether to invest in this wave. It's whether you'll have a framework ready when the next AI darling prices, or whether you'll be reacting to hype like everyone else. Let me show you the system the institutions use, the same one we've used for over 30 years. Hey, welcome to New Stock Signals. I'm Max, the digital twin of Bill Smith, founder of Renaissance Capital. For over 30 years, Bill's firm has analyzed more than 11,000 IPOs. Bill personally writes every video script himself. I hope you enjoy. He reads every comment, so share your thoughts below. Nothing in this video constitutes personalized investment advice. Always consult your own financial advisor before making investment decisions. Here's why this matters. When an IPO window reopens after a long freeze, the bar for new issues is high. The first wave of deals tends to be higher quality. Companies that waited are usually strong enough to wait. They didn't need the money in a bad market. They came public on their own terms. Miss the framework, and you'll do what most retail investors do. You'll buy the loudest deal, the one your buddy texted you about, the one trending on social media. But the loudest deal is rarely the best deal. This video is for the serious, self-directed investor. You don't need a Bloomberg terminal. You don't need an institutional allocation. You need a repeatable process, one that moves a company from I heard about it to I understand it. By the end, you'll have exactly that, a practical way to build a watch list for the year ahead, a framework to track every name from its first SEC filing to its first trade. Let me be clear, this isn't about predicting winners. It's about filtering better. Let's step back for a moment. There's a myth in IPO investing that won't die. The myth says the big institutions only win because they get the coveted allocations, the early shares at the offer price. That's not how it actually works. Here's what really happens. The institutions never get enough allocation, not even close. So they build most of their position in the aftermarket, the open market, where it's anyone's game. Think about what that means. What separates the pros from the crowd isn't access, it's process. Most investors are opportunistic. They look at one deal, the one that found them, and they make a yes or no call with no context. The institutions are strategic. They look at every deal. They run all of them through the same filter, fast, and they reject most of them early. That way, they spend their real time and money on only a select few. That's the entire game. Not working harder, filtering better. In this video, I'm going to hand you the same filter. We call it the muscle method. 6 letters, 6 checkpoints. One reason institutions buy with confidence while retail buys on hope. Muscle is an acronym. 6 checkpoints, one purpose, narrow a long list of IPOs down to a short one in minutes. The whole point is not to spend equal time on every deal. Let me walk you through it. M is for market. Studies show 75% of all stocks move in the same direction as the overall market. Buy when the market's rising, you've got a 75% chance of being right. Buy when it's falling, the same odds work against you. Even a great IPO struggles when the market is heading south. So the first question is always, is the wind at my back or in my face? The cleanest way to read the IPO market is to watch recent IPOs as a group. How are they trading? When the basket is strong, recent buyers are making money, and new deals tend to be received well. When it's weak, the opposite. U is for underwriter. The underwriter, the investment bank taking the company public, knows that company better than almost anyone. Here's the key insight. When a bank agrees to underwrite a deal, it's putting its reputation on the line. That's an implied endorsement. They're telling their biggest clients, we like this one. So you evaluate the messenger. How many deals has this bank done? Are they active? And how have their recent IPOs performed in the first 90 days of trading? A bank with a strong, active track record gives the endorsement real weight. S is for strength of industry. Think of it like this. If every tech IPO this quarter is flying out of the gate, that's a green light. You can feel more confident about the next one in line. If a sector is trading poorly, that weighs on every new name in it. Group momentum can change on a dime. Even a strong company can struggle if its peers are getting punished. Fighting the tape is especially risky with volatile IPOs. C is for core fundamentals. This is the last of the quick filters. 3 numbers: growth, profitability, and leverage. You'd like to see sales growth above 15% in the last year. Strong growth usually means the company is in an attractive space or taking share from competitors. If a company's EBITDA margin is above 10%, the business model works. High-growth tech deals are often unprofitable early, and that alone isn't a deal breaker. But profitability is insulation. When I say leverage, I mean how much debt are they carrying? Heavy debt plus heavy losses is a dangerous mixture. Either one alone can be fine. Together, they sink companies. Notice what we've done. 4 checkpoints, M, U, S, C, and we haven't opened a single dense legal document yet. That's the muscle method working before you've even broken a sweat. By design, you only do the heavy reading on deals that survive the first 4 filters. L is for legal docs. This is the prospectus, the S1, the single most informative document you will ever get on a company. The SEC forces more disclosure here than the company will ever have to provide again. Don't read all of it, read 3 sections. The prospectus summary, what the business actually is. The management's discussion and analysis, the MD&A, where the revenue truly comes from and where it goes. The numbers don't lie. The marketing language sometimes does. And the risk factors, the scariest part of the document. The lawyers list every possible problem to protect the company from lawsuits. Most of it is boilerplate, but sometimes one sentence in there is the reason to walk away. Customer concentration, a material weakness in financial controls, a massive accumulated deficit. E is for early trading. This is the fun part. You've done the work, you like the story. Now the market gets a vote. First, look at where the IPO price is versus its original range. Pricing at the high end or above signals strong demand. Near the midpoint is healthy and normal. Below the range is a warning. Either demand is weak or investors are pushing back on price. Then watch the trading itself. A first-day gain of 10% or more is a strong debut. A broken IPO, one trading below its offer price, is often hard to come back from. And here's the one most people forget. Since you'll likely enter through the aftermarket, watch the performance after day 1. Strong aftermarket trading is roughly 7% or more above that first day close, where most of us actually get our shares. That's the muscle method. Market, underwriter, strength of industry, core fundamentals, legal docs, early trading, 6 checkpoints, 1 disciplined sequence. So how do you actually use this to build a watch list for the year ahead? Here's what changes. You stop reacting to IPOs one at a time. You start running a pipeline. Let me give you the practical version. 1. Cast a wide net. Every S1 filed is raw material. Don't judge yet. Capture the name. A great IPO can come from anywhere. 2. Run the fast filters. For each name, walk through M, U, S, and C. The market backdrop, the underwriter's track record, the sector's momentum, the 3 core numbers. This takes minutes per company once you've done it a few times. Most names will fall out right here. That's the point. Rejection early is a feature, not a failure. 3. Deep dive the survivors. Only the deals clearing the first 4 filters earn your time in the prospectus. Read the summary, the MD and A, the risk factors. This is where a watch list name becomes a conviction name. 4. Watch the pricing and the open. When your conviction names finally price and start trading, you've got your last data points. Where did it price in the range? How's the aftermarket holding up? Then you decide your entry. Now the mistakes to avoid. The muscle method only works if you respect it. Don't skip ahead to the prospectus on hype. If a deal is loud but fails the market or industry check, reading 200 pages won't save you. You'll talk yourself into it. Don't confuse a big first-day pop with a good investment. The pop is fun to watch, but it is not a forecast. Many of the biggest day-one jumps fade hard once the company settles into a price that reflects real value. And don't fight the tape because you love the story. A great company in a cold sector can still be a wonderful long-term holding, but it'll hand you a much better entry point if you wait for the wind to turn. Discipline is the edge, not enthusiasm. Now, let me address the obvious pushback. I can't get IPO allocations, so why does any of this matter to me? I understand the concern, but remember what we covered. There's real opportunity in the aftermarket, and that's the same market you and I trade in. This framework is built for the investor buying after day one. Isn't this just a way to predict winners? No. And I want to be honest about this. No framework predicts winners with certainty. Anyone who tells you otherwise is selling something. What muscle does is improve your decision quality. The muscle method doesn't predict the future. It filters out the deals that were never going to work. It raises the odds. It removes the worst deals early. That's the honest goal. Better filtering, not a crystal ball. What if I run the whole process and the IPO still drops? It happens. Even disciplined investors are wrong, but here's the difference. When you've done the work, a loss is information, not a catastrophe. You sized the position with eyes open. You knew the risks because you read them. Discipline doesn't eliminate losses. It keeps them survivable. So let's bring it together. The IPO window is open again. SpaceX is the headline, but there's a pipeline of names behind it. The investors who win this wave won't be the ones who chased the loudest deal. They'll be the ones with a system. Market, underwriter, strength of industry, core fundamentals, legal docs, early trading, 6 checkpoints that turn a chaotic pipeline into a clear watch list. The same process the institutions use to invest hundreds of millions of dollars a year. And now it's yours. Remember what's behind this framework. 30 years analyzing IPOs, over 11,000 transactions. Now packaged into 6 letters you can run in minutes. If this gave you a clearer way to think about the year ahead, do 3 things. 1, check out our upcoming book, The New AI Stock Edge, the full framework you watched written down, link to pre-order in the description. 2, subscribe, so you're with us for every name that comes after SpaceX. 3, like this video. It helps other serious investors find the channel. This isn't about chasing headlines. It's about building a system that works when the noise fades. You don't win IPOs by getting excited. You win by filtering better, and clarity compounds.